On March 18th, the part-time chairman of India's second-largest bank, Atanu Chakraborty, unexpectedly submitted his resignation. He offered no specifics and memed no names. He simply stated that certain practices at HDFC Bank were not in congruence with his personal values and ethics. The very next day, Chakraborty walked that written statement back. He went on television to clarify that there was zero wrongdoing at the bank, only what he called ideological differences. The market reacted to the ambiguity with a massive sell-off. HDFC's stock crashed by 8.7% in a single session, erasing 70,000 crore rupees, roughly $8.4 billion in market capitalization. Because HDFC holds immense weight in the Nifty 50, it dragged the entire national index down with it. The market's reaction signaled a breakdown in confidence for India's most dependable bank. It forced investors to look past the executive turnover and examine the structural pressures building beneath the surface. One of those pressures started overseas, inside HDFC's wealth management branches. In cities like Dubai, relationship managers were actively targeting high-net-worth non-resident Indians. To understand the product they were selling, look at this flowchart representing a standard corporate bond. You lend money to a company, they guarantee a fixed return, and if the company goes bankrupt, you hold priority status. The lock icon means you get paid back before shareholders see a dime. But HDFC was selling a complex product called AT1 bonds. These offer higher interest rates, but they carry no maturity date. The bank can keep your principal forever. Worse, if the issuing bank's cash reserves drop to an emergency level, regulators can simply erase the bond's value entirely. HDFC relationship managers marketed these highly volatile AT1 bonds from Credit Suisse as safe, high-yield investments. They convinced clients to move secure deposits out of India to buy them, promising yields as high as 13%. Then, in 2023, Credit Suisse collapsed. When UBS absorbed the failing institution in an emergency rescue, Swiss regulators triggered the clause in the AT1 contracts. They ordered a total write-off, and $17 billion in global investor capital vanished. The bank used its reputation for safety to push a high-risk gamble onto its own clients. For many investors, the promise of a safe 13% return resulted in a balance of zero. While the wealth management scandal was breaking trust with individual clients, the domestic bank was engineering a massive structural change. In 2023, HDFC Bank executed a historic mega-merger with its parent company, the housing finance giant HDFC Ltd. Banks operate on a metric called the net interest margin. On one side of this scale, you have cheap capital coming in through standard savings accounts, costing the bank maybe 3% in interest. On the other side, you lend that money out at higher rates. The difference is your profit. When the merger completed, HDFC Bank absorbed a massive 6 lakh crore portfolio of home loans, but those loans didn't come with enough cheap deposits to fund them. To balance the scale, the bank had to aggressively raise cash by offering expensive fixed deposits at 7% interest, squeezing their profit margin to a fraction of its former size. The pain compounded due to regulatory rules. As a housing finance company, HDFC Ltd could lend nearly 100% of the money it raised. But once it merged into a regulated commercial bank, the RBI required that roughly 21% of all those deposits be locked away in cash reserves and government bonds. This rule change meant that over 1 lakh crore rupees in capital was suddenly sitting idle, earning almost zero interest just to meet compliance standards. The merger was intended to create an invincible financial juggernaut. Instead, it overloaded the bank with low-yield debt and high-cost borrowing, stalling its core lending engine. The strain is clear in the data. This gauge tracks the loan-to-deposit ratio. A bank typically stays within 60 to 80%. Following the merger, HDFC's ratio spiked to 110%, meaning they lent out more money than they held in deposits. As a result, the bank's net interest margin plummeted from a healthy 4.1% to 3.35%, dropping below the performance of its closest competitors. Looking at these figures, the stock crash following the chairman's resignation was not market hysteria. It was a mathematical response to a bank struggling to manage its own growth. The crisis reveals failures across 3 layers: the confusing executive signals at the top, the mis-selling of bonds to retail consumers, and a lending model strained by a massive merger. To regain its standing, HDFC must now reconcile its pursuit of scale with the stable, predictable operations that originally made it India's most trusted lender. The path forward is not through aggressive expansion, but through rebuilding the trust it once considered its most valuable asset.